In 2025, the United Kingdom is projected to have the highest inflation rate among G7 nations, according to OECD estimates. For an island economy long considered a bastion of stability, this is no small disruption. Why is an advanced economy now grappling with price pressures that resemble those of emerging markets? And more importantly, if inflation becomes entrenched, how far might this shock ripple across its currency, financial markets, and even the global economic order? Let's ground that question with numbers. The OECD forecasts UK inflation of around 3.5% in 2025, placing it at the top of the G7 inflation rankings. As of August 2025, the UK's Consumer Price Index, CPI, is rising at approximately 3.8% annually, ONS data. Food prices alone have surged by 5.1% year-on-year, far outstripping core inflation. Energy and utility costs have added disproportionately, natural gas and electricity prices rising by double digits in some regions. Wage growth is lagging price increases. Median real wages have contracted by nearly 1.2%, eroding household purchasing power. Meanwhile, sterling has depreciated approximately 4 to 5% against major currencies in the past year, feeding imported inflation. These figures paint a portrait. Inflation is not a sideshow in the UK, it is now center stage in its economic drama. To see how we arrived here, we must revisit past fault lines. In the 1970s, the UK confronted stagflation, high inflation, slow growth, wage price spirals. The IMF bailout of 1976 remains a cautionary tale. Sterling has faced multiple crises. 1992's Black Wednesday, when the UK was forced out of the exchange rate mechanism, is etched in economic memory. In inflation cycles of the late 1980s and early 1990s, tight monetary policy triggered recessions, demonstrating the trade-off between inflation control and economic growth. More recently, Brexit introduced persistent trade frictions, supply chain fragmentation, and regulatory divergence. Chronic stressors added on top of cyclical shocks. Across the Eurozone and within G7 peers, inflation has diverged. Some nations rusted while others welded ahead. The UK's divergence is not merely economic, but structural. By comparing past episodes, we see how monetary frameworks, fiscal discipline, and external shocks interacted, and how fragile those balances were. The direction shifted not overnight, but through a confluence of pressures: fiscal slack, persistent budget deficits, mounting public debt, high social spending commitments. Wage pressure. Workers demanded compensation for rising costs, especially in public sectors and transport. Energy dependence. The UK imports much of its natural gas and electricity, exposing it to global commodity price spikes. Government policy shifts. Chancellor Rachel Reeves's incoming budget proposals include tax increases and stimulus to secure growth, each with inflationary or contractionary consequences. Global disruptions. The war in Ukraine, supply chain bottlenecks, and raw commodity price surges feed into UK import costs. These forces collided in 2024 to 2025, turning latent vulnerabilities into active inflationary pressure. We now look at deeper mechanics. Real wage spiral risk. If inflation expectations continue rising, workers demand higher wages, creating a self-reinforcing loop. But employers resisting wage hikes provoke strikes or attrition. Political instability looms. Monetary constraints. The Bank of England, BOE, must balance between raising rates to cool inflation and not triggering a debt ceiling crisis or recession. Its maneuvering space is narrower because borrowing costs and public debt exposures are already elevated. Investor sentiment and risk premiums. Investors are now demanding higher yields to hold UK gilts. Credit agencies warn of potential rating downgrades. The spread between UK and German bonds is widening. Export competitiveness and trade balance. With costs rising internally, UK goods risk becoming less competitive globally. Imports become more expensive, especially for energy-intensive industries, worsening the trade deficit. Sterling's role in the global portfolio. A weaker pound increases the burden of foreign-denominated debt and adds inflation pressure via imports. Policy credibility and inflation anchoring. If public and market faith in BOE's commitment to 2% inflation target wanes, inflation expectations may become unmoored, a far more dangerous scenario than current price shifts. Together, these effects are not linear. They interact. A rate hike may choke growth, weaken sterling further, or provoke fiscal backlash. Before surveying possible paths, let's remind ourselves. The outcome hinges not just on external trends, but on policy choices and credibility. Baseline scenario. Inflation gradually eases to around 2.7% by late 2026, as commodity pressures fade and monetary tightening bears fruit. The BOE holds rates high but avoids recession. Growth recovers modestly. The UK remains vulnerable but stable. Stress scenario. Inflation remains stuck above 3%. Growth stalls and corporate defaults rise. The BOE is forced into aggressive tightening, triggering a downturn. Sterling weakens further, widening bond spreads and provoking a debt spiral. Other G7 economies feel the shockwaves. Reform or stabilization scenario. The government and BOE embark on coordinated policy actions, targeted subsidies, structural reforms to energy, tax reform, supply-side investment, confidence returns. Price pressures ease as investment and productivity pick up. Wild card scenario. Geopolitical shock or energy disruption reignites commodity inflation, or sudden financial contagion from another region forces capital flight. The UK becomes collateral damage in a global inflation storm. Watch points. Gilts yields. Sterling's trajectory. Inflation expectations surveys. Fiscal maneuvering. Energy price trends and consumer wage agreements. Even if inflation decays, the risk lies in making it structural. Debt trap. Higher interest costs stress public finances, forcing cuts or tax hikes, both contractionary and inflationary in cycles. Loss of credibility. If citizens and markets no longer trust BOE's mandate, re-anchoring expectations becomes far harder. Financial stress on households. Mortgage shocks, consumer credit burdens, defaults. Banking stability is at risk. International isolation. As the UK becomes seen as a high-inflation economy, it could lose capital inflows, investment interest, and currency allure. The Medici analogy, but in modern finance. When a structure built on credit and belief is doubted, it wobbles. If the UK leads the G7 in inflation in 2025, it is not merely a national anomaly. It may be a signal that traditional monetary fiscal frameworks can no longer contain global price pressures. The real question, if one of the most established financial systems cracks, how far could the contagion run, and who will hold the pieces together? If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.